COVID-19, the global economy is at a standstill. Markets are in turmoil.
The S&P 500 opening lower by more than 8%. Of course, that greater than the 7% level that triggers the level 1 circuit breaker.
Retail sales down.
Oh my God, look at this. All right, retail sales year to date minus 20%.
Unemployment up.
4.4 million people filing for initial jobless claims last week.
Even if ultimately temporary, it will have a significant impact on economic activity.
Some economies are opening up.
To preserve the health of our citizens, we must also preserve the health and functioning of our economy.
Despite warnings, opening up too early could have consequences.
Ultimately, the virus is going to determine when we really can safely reopen.
In this time of crisis, how can investors navigate volatility and uncertainty? We convene the biggest names across finance, economics, and investing to help investors weather the turbulence. We are live in Hong Kong, Dubai, London, and New York for exclusive interviews and smart analysis. This is Bloomberg Invest Global.
Hello and welcome to this virtual Global Invest. I'm Stephanie Flanders, Senior Executive Editor of Economics at Bloomberg and Head of Bloomberg Economics. Over the course of the next 3 days, as you've just heard, we're going to be hearing from some of the most influential names in economics, in finance, in markets, and we're roaming across the globe, Asia, the Middle East, Africa, Europe, and North America, all to help you understand what on earth is going on and how we're going to get out of this current situation and what the future looks like in this extraordinary COVID global economy. Let me start briefly by thanking CMC Markets, who are our European sponsor. They're helping make possible this event. If you go to the resources section, you can find out a lot more about CMC Markets. Got a few housekeeping notes. Make sure if you are tuning into us, you're on Firefox or Chrome. You'll find it a lot easier. If you are having trouble with audio or video, we found often if you refresh your browser, that can make a big difference. And you can restore Windows using the buttons at the bottom of your screen. And you can change the size of each window. So if you want to not see very much of the speakers and you want to look at the other parts of the screen, you're very welcome to do that. This is an interactive session and we encourage you to submit questions. If you look at that Q&A box on your screen to the right-hand side, you can submit questions there and I'll be trying to weave them into my conversations later on. We'll also be asking live polling questions, and those questions are just going to pop up on your screen as we're talking, and you would just need to take a minute then to register your responses. And please engage with us on social media, on Twitter, using hashtag BloombergInvest. I should be putting this interviews also on my podcast, Stephanomics, which of course you should all be signing up for. So with that, I'd like to introduce our first guest, Nouriel Roubini, who's Professor of Economics at New York University's Stern School of Business. He's actually also a former colleague of mine at Bob Rubin's Treasury Department too many years ago. Nouriel, welcome to Global Invest.
It's a great pleasure being with you today, Stephanie.
The name, the phrase, the tag Dr. Doom, has stuck with you for a long time, and you're not making any great effort to shake it off because I know you have a pretty stark forecast for the global economy coming out of the COVID crisis. Maybe not now, but in the near future, you see the conditions for a decade of global depression. Just talk us through what makes you give that forecast, even if we do see quite a rapid bounce back in some economies over the next few months.
Well, I would say that for the time being and for this year, my view is that the recovery is going to be anemic, subpar, below trend, more of a U-shaped recovery rather than a V-shaped recovery that is the one of the consensus on Wall Street. And the reason is that there is going to be a painful process of deleveraging both by the corporate sector and the household sector that have to be spending less, saving more, and doing less investment, capex or residential investment. But that's a story for this year and next year. What I pointed out is there are some forces in the global economy, there are some imbalance and risks that have been ongoing for a decade, and the coronavirus crisis has exacerbated them. And these may be leading over the next few years to something that I would call the Greater Depression of the 2020. If I had to summarize it, I would say in brief, number one, there are 10 factors. One is debt and deficits are going to lead to defaults over time with a massive buildup of private and public debt. Secondly, we have demographics with aging of population, both in advanced economies and emerging markets, and unfunded healthcare system. And now we'll have to spend more on coronavirus and other types of pandemic. Three, in the short run, there's a slack in goods market, labor market, real estate, commodities that's leading to deflation. And then the way we're going to be fighting it is by debasing currencies, essentially effective monetization of fiscal deficits. But this monetization of fiscal deficit that prevents deflation in the short run over time might lead to stagflation, a combination of stagnation and inflation, because we're going to be facing now with a significant amount of negative supply shocks in the global economy. One of them is deglobalization, decoupling between US and China, fragmentation of the global economy, and having balkanization of the supply chains. The other one is there will be a slower pace of technological innovation, even if we're going to be seeing ongoing disruption. So if you impose monetization of fiscal deficits in an economy with negative supply shocks, because we deglobalize and there is less technological innovation because of the decoupling between the US and China, eventually the inflation genie can get out of the bottle. In addition to deglobalization, I think there is also a democracy backlash. More and more countries are becoming more populist, more nationalist. They're going to try to defend their own, protect their own firms, their own workers, and that populist policy, of course, are going to have a negative impact between US and China. This Cold War is going to become a colder war, and that's going to lead to a division in the world economy between a group of countries close to the US and the one close to China. Finally, I think there is going to be a digital rivalry between US and a major rival of the United States. That's going to lead to global cyber warfare, and the big tech sector is going to become a weapon in trying to contain the strategic enemy of the United States. And finally, there are what I call the deadly man-made disasters. They're not natural disasters, pandemics, or global climate change, and the costs coming from pandemic and the global climate change are going to be becoming more severe over time. So these are 10 deadly trends that were ongoing before this crisis. They're going to be exacerbated by the crisis. And I think that by the middle of the decade can lead us to a greater depression.
There's so much to unpick in that, but I know that what you said at the very beginning will be perhaps, at least short term, most interesting to people watching, because you're saying we could get something like a V-shaped or maybe a U-shaped recovery coming out of this. And frankly, people in the markets could do pretty well, continue to do well for quite a long time. How long do you see this system continuing in this way before the kind of the underlying problems that you've spoken to, which, as you suggest, have been going for a long time, really come back to haunt people and start damaging investors, let alone the rest of the world?
Well, in the third quarter of this year, there's going to be a recovery after a very severe recession in the first and the second quarter. So for a quarter or two, it may look like a V-shaped recovery, but the way I differ from consensus is that consensus believes that by next year, the V-shaped recovery is going to continue, that growth is going to be something like 6% in the United States, 3 times as much potential, while I see the recovery being strong only in the third quarter and then fizzling out by the fourth quarter, and then becoming very anemic by next year. And the main reason is not just the fact we're going to have a second or a third wave, but if you think about it, after the global financial crisis, firms that were firing workers and they rehired them in a way that was different from the past, not formal jobs, not full-time jobs with good wages and good salaries and benefits, but gig workers, part-time workers, hourly workers, freelancers, contractors. This time around, we've shed already something like between 20 and 30 million jobs. And when the rehiring is going to occur, that type of precarious job is going to become the norm. Most firms are highly leveraged. They have to survive and thrive by cutting costs and saving more. How they're going to do it? By reducing labor costs and first firing people and then rehiring them in a more flexible way. The trouble is that what's my labor cost is somebody else's labor income. And as the corporate sector deleverages by spending less, saving more, and doing less capex, then there'll be a more anemic recovery of labor income because there is more precarious jobs. There'll be a very large unemployment rate. And even the households have to be more cautious. They have to be more risk averse. 40% of US households have less than $400 of liquid cash in the case of an emergency. Your income is going to be more precarious, it's going to be weaker. Lots of people are going to be barely having any jobs. They'll have to save more and spend less, and they'll have to do also less investment, meaning residential investment. So there'll be an option value weighting both for the corporate sector and the household sector. There'll be more risk aversion. That implies less spending, more saving, less capital spending, less residential investment, and that's why the recovery is going to become like a U. Currently, markets are pricing in a V-shaped recovery of the economy. That's why they rallied so much. Of course, they rallied a lot also because of the liquidity by the Fed. But I think that people are pricing in expectation for recovery of growth and earning that are totally not consistent with the fact that the recovery of the economy is going to be a U rather than a V.
Just to push back a bit on some of that, what you've described, one way of putting it would be that there is a system that came into this that had flaws, many of which have inspired populism, the rising inequality, and you believe that the response to the crisis will exacerbate those things. And that's certainly what many people are forecasting, that we're going to see a further inequality and a further damaging of employment rights and labor income, which will ultimately, in a kind of Marxist way, sows the seeds of its own destruction. But there is a view that says, you know what, this has been a wake-up call, this crisis, and even the people who doubted before that you need major reform to make this a more inclusive world are now going to realize they have to do something different. Do you give any credence to that, whether in the US or anywhere else, that actually you could have a reset coming out of this, following on some of the wage subsidy programs, for example, that we've seen that have in the US put money into poorer people's pockets in the last few months, actually pushed up their spending in the last few months, so it's not far below where it was before the crisis, even if they've lost their jobs. Can you see a reset coming out of those kind of policies we've seen in response to COVID, maybe in Europe, that helps to slow down or even reverse some of those trends that you're talking about?
Well, my view is that since the corporate sector in the US, but also in many other advanced economies and emerging markets, is highly leveraged, many firms right now have been, for the last decade, building up debt and leverage, CLOs, leverage loans, high yield, high grade, fallen angels. We're speaking about trillions of dollars. Share buybacks, they increase debt and reduce the equity of the corporate sector. So many firms right now are either bankrupt or on the verge of bankruptcy. They have to do and take action to try to survive. And what are the actions that have been taken in the United States? We lost in the United States in the last few months many more jobs that we created in the last decade. Depending on how you measure it, we've had between 20 and 30 million people have lost their jobs. And the corporate sector first fires them, and then when they're going to be rehiring them, they're going to do what they've done after the global financial crisis, gig workers, contractors, part-time workers, hourly workers, freelancers. That was what happened 10 years ago when the corporate sector was not highly leveraged. This time around is much more leveraged, and therefore the reaction is going to be one of continuing more of the same. It's going to create more precarious jobs, more gig workers, more economic uncertainty for labor, and more need then for the household sector to spend less and to save more and to do less investment in real estate. That's a reality. I don't see a radical change in the United States in terms of economic policy. Yes, if Trump were to be losing the election, that's an if, and if Biden were to be coming to power, maybe economic policy is going to be becoming slightly more progressive. But there are major forces, including also technology. The digital disruption is going to imply that over the next few years, there'll be many more jobs that are being destroyed, not just by globalization, trade, or migration, but by technological innovation that is capital intensive, skill bias, and labor saving. There's going to be disrupting millions of other jobs. And even if there's going to be reshoring activity for a higher cost, then that reshoring is going to imply essentially production that is even more capital intensive, like, for example, more automation, more robotics. The factory is going to be reopened in North America, not going to be full of workers, going to be full of robots. So unless there is a very radical change in economic policies, the trend of globalization, of technology, of the weakness of labor, of unions, and so on imply that labor is weak, capital is mobile, and the entire system has been essentially one where income has been going on from the workers to capitalists, from wages to profits, and from those who spend more to those who save more. And yes, eventually you get this Marxian underinvestment and underconsumption if you have that redistribution of income. But the inequality has been rising, and I'm not sure that these major trends are going to be reversed anytime soon.
Just moving on to the debt piece of your analysis, because that's one of the things that's the forcing event is when the global economy, in a sense, cannot continue to carry the debt that it's carrying, and that causes a threats to market confidence and much else. I think there's been a view, perhaps unspoken, those who have a more optimistic view of the next 5 to 10 years, looking and are investing in the markets on the basis of it, that we're either going to have more of the same coming out of this, namely very low inflation, low interest rates, but with that, the affordability of this much higher debt stock, corporate and public debt around the world, or we might get inflation, and that might cause some bumps down the road, but it will at least make that debt easier to grow out from underneath. Your view is actually that's just too optimistic, that you can have the inflation without really resolving the debt issue. Is that right?
Well, my view is that certainly in the short run, I agree that there are more deflationary rather than inflationary pressures. There is a massive slack in goods markets, in labor markets, in real estate, in energy and commodities. So this year, next year, there'll be lowflationary and deflationary pressures. But I've pointed out, however, is that we're doing massive monetization of fiscal deficits, effectively already in variants of MMT or helicopter drop of money. And if the shocks that hit the economy are demand shocks like the global financial crisis, then monetization of fiscal deficits prevents stagnation and deflation. But what I'm pointing out is there'll be major forces that are going to imply negative supply shocks in the global economy in the next few years, because there were two major forces that kept inflation low for the last decade. One was globalization, and now we're in a process of deglobalization. And the second one was major technological innovation that were also increasing productivity, reducing costs. And right now we're going to have a digital wall being built between US and China, and we're going to have two separate AIs, two separate internets, two separate 5Gs, two separate telecom systems, and so on and so on. And for example, we may for geostrategic reason not want to use the Huawei 5G, but the Huawei 5G is 30% cheaper than the one of Nokia and Ericsson, and 20% more productive. So if we're going to install a 5G network that's going to be not Huawei, is going to be 50% more expensive than before. That's a negative supply shock. So both technology and deglobalization imply negative supply shocks. Now, last time around, when we had negative supply shocks and we had easy money, easy fiscal in the 70s with the two oil shocks of 73 and 79, we ended up with inflation, stagnation, recession, and inflation. So either this debt become unsustainable, or if we're going to try to wipe them out with inflation, then we're going to have a trap of stagflation. And you remember the misery index in the 70s and what happened when you have high inflation and you have an economic downturn. Certainly the 70s was not a great model. So either way, we're going to be in a trap.
It seems like you just mentioned the deglobalization as one of these fundamental negative supply side shocks, which is a good opportunity to have the polling question for this session, which should be popping up on your screen pretty soon. And the question is, what's next for US-China trade? Either the phase one will move ahead, the parameters will be changed and agreed, the US will pull out, or China will pull out. I suspect if China did pull out, the US would immediately announce that they pulled out first, but I won't even go there. We should, but in terms of just pick your A, B, C, or D, and we'll wait a few moments for the result of that. I mean, Nouriel, I guess I feel like I'm just constantly putting the Pollyanna view to you, but it's one always has to look for chinks of light in your analysis. Historically, people who have bet against integration have tended to be wrong, especially even at times where we felt that there were irrevocable forces of division. I mean, of course, we've had the last great period of globalization was broken up by World War I and then World War II. But many people would say, looking at the trends we've had over the last few years, even if globalization slows down, it's not going to reverse, and it could still continue to bring enormous benefits, particularly perhaps to developing countries and countries across Asia especially. So what is it about now that you think is different from the other times when people have declared the end of integration?
Well, as you pointed out, there was a reversal of globalization that occurred after World War I and then with the onset of World War II. And in both cases, there was the rising of a new power, first Germany and then Japan. They were strategic rivals of the United States. And as you know, Graham Allison, who wrote a book about the Thucydides trap and whether US and China are going to avoid it. We have a new rising power, that is China, that has a different economic, social, and political system from the United States. And you have an existing power. And this Thucydides trap is ongoing. There's a beginning of a Cold War between US and China. This Cold War is becoming colder. If you see what's going on technology, on trade, on FDI, on investment, on data, on information, on financial arrangement, on internet, on pretty much every aspect of the economic relationship, there is now a beginning of a decoupling. And it's not just decoupling, but then both US and China are going to say either you are with me or you are against me. And therefore, either use my AI or their AI, my 5G or the other 5G. And therefore, the rest of the world is going to be in a very difficult situation having to choose between US and China. So what's different is like in the past, when you had the rise of a new power facing an existing power, we had initially a Cold War, and in the last two episodes, actually, we had a real hot war. Now, I'm not predicting for the time being a hot war between US and China. I think that given the asymmetry of power, conventional and unconventional between US and China, that's unlikely, but we're seeing every day an escalation of this Cold War. And that's already leading to a process of deglobalization, and it's not just deglobalization on trade, but most importantly on technology. And today those 5G networks are running our phones, but tomorrow they're going to be running our system of, say, autonomous vehicle, making sure that millions of them don't hit each other. And tomorrow pretty much every piece of consumer electronic in the Internet of Things is going to have a 5G chip, even your lowly Chinese toaster or coffee machine or microwave. And therefore, if you're not going to use the 5G of China, You're not going to also want to use the toasters or microwaves or coffee machines of China because they're potentially a listening device if you believe that there is a backdoor from Huawei's 5G to the Chinese government. So that's where the war on tech becomes also a war on trade, and it's going to only escalate over time. Unfortunately, I think that's the trend we're facing. We already were in peak globalization after the global financial crisis, and we had inward-oriented nationalistic policies in many parts of the world because of the global financial crisis. Now you have all this geopolitical layer with China is going to exacerbate the process of deglobalization. Of course, it's not black and white. I'm not saying there's not going to be any trade of any sort, but we are in a trend towards gradual but persistent deglobalization.
We should get to some of the questions that people have put. And Peter Goodman had a question. We focused on the US and the world. We haven't thought about some of the differences across countries, at least within the developed world. And he points out that countries in Europe have taken different approaches to the pandemic when it comes to the economic impact of the pandemic, focusing more on employment in the case of many European countries. Which do you think is working better? Which do you think is best helping economies move out of this crisis and maybe even reduce some of the threats that you're talking about?
Well, there is a difference between the US labor markets and the European. The US labor markets are more flexible. So in the US, firms have decided essentially to fire at will their workers, and then we've provided to these workers significant amount of large but temporary unemployment benefits, while in Europe you have a system of reshoring where you keep most of the employees on a payroll, and then you give them between 2/3 and 3/4 of their salary, and the rest of it is shared between the firm and the government. And that's why in the US the unemployment rate effectively measured has gone from 3.5% to 17%, while in Germany there's been only a very modest increase in the unemployment rate, and also in other parts of Europe. I would say that usually labor markets in Europe are criticized for being rigid by having large hiring and firing costs, but in a situation like this one with a shock of this sort, actually the response of Europe is a better one, but by keeping employment, then the recovery of jobs and income is going to be slightly more robust. While in the United States, we've had literally a bloodshed, and we've lost in 3 months the entire sets of jobs, 22 million that were created in the last decade. So this time around, actually, I think that the European labor market and the institutions are giving you a better response, going to lead you to a slightly better recovery than the United States. But the shock in Europe has been heavy, and probably the economic downturn in Europe is going to be as severe, if not more severe, than the United States, because, of course, the COVID hit very hard countries like Italy and Spain and some of the other ones in the periphery of the Eurozone. So in spite of this different setting of the labor market, the economic downturn in Europe and the Eurozone is not going to be less than the United States. It's only the difference between how much the hit is taken directly by labor in one way or another one.
I guess it also depends on how much you think of this shock from COVID as being one that causes structural change in jobs. Or you actually want people to move into new jobs as a result of this, or whether you want really just to hold on to the jobs they had. And we're only going to see that over time, how much disruption, structural dislocation has been caused by this crisis. But it raises a broader question, and I think this will be my last question to you, and some of the people with their own questions, some of the people watching you have wondered, for example, Piyush Rakecha, that the same job loss fear was raised when PCs came in and replaced all the paperwork. Is it not possible that we will find new jobs like we found the last time? I guess just to add on another question that somebody had is, could there be good news here? I mean, many people are investing in high-tech companies that seem to do fantastically well. It seems odd to say we're going to have lots of technological change, but it's not going to produce growth, and it's not going to produce income for someone, which might then be redistributed. Is there no good news here?
Well, the difference is in the previous industrial revolution, jobs went from agriculture into the industrial sector and from the industrial sector to the service sector. But what's happening right now is not only that the factory of the future is going to be a bunch of robots and machines and just maybe one person manning these machines, but now the same process of AI, robotics, automation is completely disrupting tons of jobs in the service sector, from retail to transportation to education to government services to pretty much anything under the sun. So those who say we're going to create other jobs, is not clear what are going to be those jobs in the future are going to be created. For every job that is created by Amazon, there is on average 10 jobs in retail that are disappearing. So I think that's a difference compared to the past. And then for the time being, all this technological disruption has not led at the macro level to data that are showing an increase in productivity. Eventually, of course, if there's going to be a significant technological disruption, there may be an increase in productivity. The economic pie is going to become larger, but since technological innovation is capital intensive, skill bias, and labor saving, those who own financial and real capital are going to do well. Those that are in the top 20, 30% of distribution of skills, education, human capital are going to do well. But if you are a blue-collar worker with low skill or medium skill, but now even if you are a white-collar worker with low skills or medium skills, your income and your job is going to be disrupted completely by technology. And therefore, the issue is not whether the economic pie is bigger, but what's going to be the distribution of the benefits. And distribution of benefits is going to go to capital and those that are very, very high skilled. And everybody else is going to be left behind. That's why we have the rise of populism. Populism is driven in part by this income and wealth inequality. It's driven not only by globalization, but also by technological disruption that increasingly are threatening white-collar jobs as much as blue-collar jobs. And therefore, the tension and the political backlash against it is going to become severe. So the pie is going to be bigger. The distribution of the benefits is going to become even more uneven.
Okay, well, Noura Rabini, I guess so. The answer to is there any good news? It's hard for you to see the good news, but we will be seeing if Professor Joe Stiglitz has a different perspective later on. But in the meantime, Noura Rabini, thank you very much for joining us. I should say that with a bit of a plug for Bloomberg Economics. A plug for Bloomberg Economics here. We have a lot of resources on the Bloomberg terminal about the global economy, about the potential impact of US-China trade wars, and some long-term analysis of the shape of the global labor force, which has a lot of bearing on what we've just been talking about, as well as the short-term impact of COVID on different economies around the world. Beco Go, if you're on the terminal, is the place to get for all of those resources from Bloomberg Economics. But another great resource is Bloomberg Intelligence. And we're now going to hear from Stephen Chu, Hugh Worthington, and Damien Sassover from Bloomberg Intelligence on the topic of gauging the rebound in global rates and credit.
The coronavirus pandemic is enlarging sovereign debt loads and fueling local demand for dollars, aggregating fiscal imbalances and exposing emerging market investors to greater risk. Good afternoon. My name is Damien Sassower. I'm the Chief Emerging Market Fixed Income Strategist for Bloomberg Intelligence. And for the purpose of this presentation, I think it's instructive to see just how far we've come since mid-March, when EM dollar and local currency investors were grappling with losses on the order of 13% and 15% respectively. In slide 1, we break down total returns for the EM US dollar aggregate bond index into its constituent parts. And what you find is that the positive returns from carry, which is coupon income, and duration, which are movements attributed to shifts in the US yield curve, fail to overcome the losses we're witnessing from spread-related factors. And so Latin America obviously is weighing from a spread perspective on most returns year to date, with Brazil standing out, Mexico standing out, and of course, Argentina down 19% year to date, standing out in the eyes of investors. Slide 2, we do the same thing for EM local currency bonds. And what we find here is that, again, the returns attributed to carry, which is coupon income, and duration, which is attributed to movements in the local currency bond curves for each of the 20 countries in the index, fail to overcome the negative performance we've seen from FX, from currency losses. And so here, what you find is that it's the high beta currency crosses, specifically those in Brazil, Mexico, Russia, South Africa, that have really weighed on returns year to date. And with the index down roughly 4% today relative to down 50% back in mid-March, we can really see just how far we've come on the currency side and whether or not those gains are going to hold for investors. So what is driving some of the gains we've seen across emerging markets? Well, it's the extraordinary central bank stimulus, both across developed markets, but more importantly, across emerging markets, which are really pulling yields down and driving up the valuations of the underlying debt. And so we've seen roughly or more than 5,000 basis points in central bank rate cuts since 2018 across the whole of emerging markets. That's unprecedented, never before seen. And what that's doing is, while it is fueling duration gains, we question just how much capacity many of these central banks have to continue to cut rates going forward. Shifting to slide 4, what we've seen is that with all these rate cuts that we witnessed across both developed and emerging markets, the average yield to worst for the Bloomberg Barclays global aggregate has fallen from 2% at the end of 2018 to 1% today, or just under it, call it 99 basis points. So a rough halving of the yield or the income that investors can expect from investing in a diversified bond portfolio of investment grade debt. And so while that has pulled down EM local currency yields as well on the order of 210 basis points over the period, we do think we're going to see a bit of a rotation, and we are beginning to see that into some of the high yielding emerging markets that are within that index, specifically Indonesia, Mexico, and Russia. Those 3 countries have average yield to worst in excess of 4%. And so while we do expect to see that shift continue, there are still risks prevalent across the EM marketplace, and the concerns that are growing amongst the eyes of investors as we approach the zero lower bound in the US are not going away anytime soon. Thank you for your time.
Hi, I'm Stephen Chu, the Asia FX and Rate Strategist at Bloomberg Intelligence. We will discuss why we are positive about the Chinese yuan and the Chinese government bonds in the post-COVID world. Firstly, with the Fed printing trillions of dollars to battle the pandemic crisis, we believe by now the dollar credit or dollar equities may deem to be less appealing to some foreign investors, and the search for yield behavior may render capital to eventually flow back to the EM markets, especially EM Asia. Asia may be ahead of the rest of the world in virus containment and macro recovery, and their respective equities and bonds should have alert to the foreign investors, we believe. In fact, the Asia capital outflow momentum on a 90-day rolling basis has been slowing as inflows start coming back in recent weeks. Within Asia, one obvious destination will be the Chinese yuan assets, especially China bonds. China has less urgency to normalize monetary easing even in the post-COVID world, as the PBOC did refrain from bold rate cuts or triple R cuts earlier this year. At the moment, the 10-year China government bond yield is over 200 basis points above the US Treasury yield, and even 50 basis points above with a FX hedge basis. While other EM Asia bonds may offer higher yields, their currencies are more volatile and come with pricier FX hedging costs. Now, in fact, FX hedging may not be necessary as the yuan itself has long-term appreciation potential. With the US dollar facing a structural downtrend in the second half of the year due to the Fed's heavy printing, the yuan itself has headroom because its role as a reserve currency could thrive from here. Foreign investors, especially the central banks and sovereign wealth funds, may further diversify their research into the yuan and China bonds, we believe. Finally, China's bond curve might have bear flattened too much since May, according to our positioning analysis. Here we look at the heat map of Z-scores of various spread buckets of the China bond curve, and we found that the spread with the 3-year as the front rate has bear flattened too much. In fact, the 3-year 10-year spread has flattened all the way from above 110 basis points, which by the way was the steepest since 2010, to below 50 basis points right now. The reason was that PBOC disappointed market with the lack of monetary easing over the last few weeks. But that makes sense because PBOC really didn't go for bold easing at the beginning of the crisis. So all being said, we think now could be a good window for boost steepening in the China bond curve again. And the bondholders may prefer to stay in shorter duration, in our view. Thank you. For more information, you can find us at Bloomberg Intelligence on Bloomberg.com.
Hi, I'm Hugh Worthington. I cover European rates and government bond research at Bloomberg, and I have done since October 2018. And I'm going to talk to you a little bit about the European government's response to the coronavirus crisis. Well, if you look at this chart here, it probably shows you some of the issues that we've got. The response to the crisis is very similar in Europe as it's been elsewhere. There's been an enormous cost of funding the various programs that are being put in place to fund the recovery from the virus and the response to it. So net debt issuance in Europe has gone from something like 170 to 200 billion euros expected at the start of the year to around €1 trillion currently. And that's got to be taken down by somebody. Now, in the past, the ECB has not been keen to engage in QE early on when we had crises. And in March, the ECB almost dropped the ball again. They said they were not here to close spreads. And we saw very quickly a very rapid deterioration in funding conditions for Italy and Spain in particular, to the extent that people are probably getting concerned about their ability to fund their response to the crisis. So the response was very quickly. They came in with a new QE program, this time the Pandemic Emergency Program, 750 billion euros at first, and then more latterly raised to 1.35 trillion euros. Now that basically means that the net issuance has been taken down completely for this year. And in fact, the funding situation as we are now, in the second half of the year, around 300 billion euros of bonds will need to be sold to the QE program. So the funding conditions look pretty good for this year. But the ability to depress yields is very key. The credit rating agencies are very, very aware of the fact that a lot of countries, in particular Italy, debt burden is going through the roof and not probably sustainable in terms of keeping it within an investment grade rating. And then we could get concerned about things like what might happen in terms of forced liquidations by foreigners in particular. So for now, I think things look okay, but the concern, as I say, is much longer term, that next year when the QE support falls away and those debt burdens have gone up and up and up, the rating agencies may well look to start to act again, and you could see pressure on those yields. Now, there's a response hopefully put in place that the signs that there's been some better EU-wide approach to the crisis, but it's not debt mutualization. There are some grants, but they're very small and they're taking a long time to come through. Only about 4 or 5 billion next year. So it may well be that the burden is going to stay very much on the ECB, and they are going to have to do more and possibly faster, and the support will have to stay in place throughout the whole of next year to keep yields and spreads under control here. And that's all for us. Thank you very much.
Well, thanks to Bloomberg Intelligence for that. We're going to move to our next interview now. I'd like to welcome the Nobel Prize-winning economist, Joseph Stiglitz, Professor of Economics at Columbia University. Joe Stiglitz, great to have you with us.
Nice to be with you.
Now, I don't know whether you heard, but I suspect that you're familiar with some of his analysis. Nouriel Roubini is not seeing a lot of light in the current global situation, even if you do have a short-term bounce following this extraordinarily steep decline during the COVID crisis. Do you basically agree that we have the ingredients here for a very long-term global depression, or do you see more capacity to get something slightly more positive out of this?
Well, I think the critical issue is what policy governments pursue. The second critical issue, of course, is the pandemic itself, and we don't know when that will be brought under control. But assume that we got that under control, the big issue is how will governments policy respond? And we need to be frank, there's a lot of uncertainty about that. For instance, one side says we need to provide the unemployed with assurance that we're going to continue the unemployment insurance as long as the pandemic continues. It's what we did in 2008 in the global financial crisis. The other side is much more hesitant to do that. And now, picking up a point that Nouriel emphasized, a big factor dampening the economy is uncertainty, precautionary behavior. And that lack of assurance on the part of government that it will be there is going to exacerbate the kind of uncertainty that's going to lead to limits on consumption and investment.
So how can governments confront that head on? I mean, you're quite right that we've seen this precautionary savings soar in the US particularly. And funnily enough, the low-income households who are on the higher federal benefits currently have their spending has held up because in part their benefits may be more than what they were earning before. But how can those, as you pointed out, those federal benefits might expire in July? How should a government try and get over that problem? Because, of course, as you said, we don't know if there's going to be a second wave. We don't know how long this recession is going to be. It's completely rational for businesses and households to hold back.
So the first thing is we need to have an assurance that government programs will continue so long as the pandemic continues. You know, in the beginning, back in March, people thought this was going to be a 3-week lockdown, 4-week lockdown. Certainly by the beginning of June or the end of July, things would be under control. No one thinks that today. We're worried about a second wave, a third wave, a perpetual wave. So we need the assurance that the government isn't now providing. Some countries are thinking about more specific ways of what you might be calling collectivizing some of the risk. For instance, telling companies, if you borrow to make an investment and the pandemic continues, we will allow you to extend the payments. So you don't, sometime you're going to want to make those investments, make them now, and we'll bear some of the risk. Some countries have provided, for instance, time-dated spending vouchers. So to encourage people to go spend now, there's underemployment. From a social point of view, this is good, but we understand your fear about getting in debt, and this is a way of encouraging spending today.
As you, some of the issues around this is, there is a lot of support going to businesses now, but we don't know for sure that that is going to go into investment or even into jobs. And at Bloomberg, we've looked at how many big companies in the US have been raising bonds very cheaply, raising $1 trillion worth in so far this year, more than in the whole of last year, on the back of the Fed easing policies. But they're also cutting jobs. So do you think there should be more strings attached to some of this support?
Yes, there was an interesting study that pointed out that particularly the PPP program seems to have had no effect on retaining employment. It was an extraordinarily badly designed program, and even worse, the implementation with the money going to those who were most connected to the banks and to those who least needed the money. If government has never spent so much money, and we ought to have a say on how that money is used. It shouldn't be a blank check. When I was at the World Bank, we always put conditions. I thought sometimes they put too many conditions, but putting certain basic conditions that you retain your employees, that you treat your workers in a decent way, that you move toward a green economy, that we help, with a vision. What kind of an economy do we want emerging from the pandemic? To me, this is one of my major criticisms of the programs. The idea behind them was we ought to go back to where we were in January 2020. My view, and you've talked about that a little bit during this program, is there were a lot of problems with the American economy and the global economy in January 2020. Inequality, the health status of Americans was going down, not very good. We hadn't begun the green transition. So there were so many things that we knew we needed to do. This was an occasion with the government spending so much money to help move our economy along in the right direction.
I want to follow up on that sort of long-term vision in a minute. But of course, a big part of the response we've seen so far, which isn't necessarily aimed at the things that you're talking about, has been the central bank response. And that has at least had a short-term effect, it seems, of propping up financial markets. So we had a question now, a polling question for people who were listening to this about whether there's a limit to what central banks can do to shore up the markets. And I think the answers to that will be coming up on your screen. Please do take a second to pick A, B, or C. Is there a limit to what central banks can do to shore up markets? I think we're getting quite a lot in the sort of middle category, that it's not a long-term solution. So I guess going back to the longer term, can central banks be part of that longer-term answer? Should we, is this the end of an era of independent central banks? They shouldn't be worried so much about inflation. They should be helping to tackle inequality, raise wages. What's your view?
First, I think there is a limit to what central banks can do, but they can do a lot. So they're really important. And I think I'm very supportive of the broader view that they seem to have taken on. I've always criticized them in the past for not taking into account the effects of their policies, for instance, in increasing inequality. They played a big role in increasing wealth inequality. And it seems that today they are taking that more into account, partly because that's very much related to their main mandate. If you have, as Nouriel Roubini pointed out, if you have increasing inequality, you're going to have deficient aggregate demand because the people at the top spend a lot less than those down below. So you cannot ignore the impact on inequality. The IMF has put inequality at the center of their agenda. And when they first did that, Dominique Strauss-Kahn said, we're doing this because our mandate is making sure that global growth is strong, and you can't do that without at least paying some more attention to inequality.
Do they perhaps have more scope for doing that now that they're effectively propping up government fiscal policy? A lot of people have worried about the fact that coming out of this, it's central banks, we're effectively seeing monetary financing, money printing to help make very high government spending and borrowing sustainable. But does that perhaps help if that's the main channel of their policy going forward? Because if they're only trying to prop up asset markets, we know that does increase wealth inequality. Should they move away from trying to protect markets altogether?
Well, I think there are some risks here. I was very concerned when they started propping up junk bond markets. And the reason is the classic reason of moral hazard. Some of these companies were playing at the edge. They were taking on a lot of debt. People warned them that's risky. If everything goes well, fine. But sometimes things don't go well, and the pandemic is a quintessential case where things didn't go well. And I think there is a legitimate view that says some of these companies ought to be paying the price. And if you don't do that, you will have too much debt in the economy. For the bigger firms who did this, we have a good law called Chapter 11. You let the shareholders bear the price. They lose the value. The bondholders become the new shareholders. Not a big deal. Bigger problem for small and medium-sized enterprises.
And thinking about the whole world, our economists have looked at what response emerging market economies have been able to do to COVID compared to the enormous amount of money flowing out of finance ministries around the developed world, and indeed all the central bank money printing. And it's a fraction. Most of these emerging market companies have not been able to, if you like, fill the hole that's been left by COVID or might be left by COVID. What's the most important what are the risks coming out of that for the whole world? But what should we also be what do you think is the best answer to that for helping them?
Well, we are a globally integrated economy, and we should remember that it was the emerging markets that helped bring us out of the 2008 crisis. We will not have a robust global recovery unless all the world is recovered, and that includes the emerging markets. The emerging markets are clearly more vulnerable, both in terms of health, and they don't have the economic resources, as you pointed out, to respond anywhere near to the extent that the United States or even Europe have responded. What should have been done was for the international institutions to step up and provide them more money. They did provide some. At the G20 meeting, there was an agreement to use all available instruments. And one of the most important instruments is an issuance of called special drawing rights. It's like IMF created money. They have the authority to do it without going back to the governments, parliaments, of issuing more than $500 billion. And unfortunately, because the opposition of two of the countries, the US being one of them, that did not happen. So that's one of the first things that needs to happen. The second thing is there's going to be a lot of countries that are going to be facing sovereign debt problems that won't be able to repay their debt. And there needs to be a way of restructuring those debts. So far, the private sector has given every indication that they don't understand that there's a pandemic going on. They have no humanity. They talked about social responsibility. They talk about all these fancy words about now we get it, we understand, we have an important role to play in our society, and they're acting in just the opposite way. A dollar for them is worth thousands of people dying in the emerging markets. So I think this is going to be a critical moment for global capitalism. If the global financial markets continue in their hard-headed way of squeezing these emerging markets, Nora Rubini was talking about the battle that's going on, the new Cold War. Well, American-style capitalism is going to take a beating if America's financial markets continue to behave in the way that they've been behaving.
I guess that was partly at heart of some of the things I was asking Muriel, because he seemed to see no potential that capitalism might save itself in the way that perhaps they might have done. We might have said that there was a reset in the 30s in the US and in the 40s in response to some of the threats of populism and the threats to capitalism. One question has come in from Michael Chekim. Can market economies change, reform to be more socially, environmentally equitable, fairer, all the things that you're talking about, while with companies still being profitable? I guess that's the question. And if capitalism does reform itself, can it still make money?
Yeah, so let me add two parts of that question. One, I think the answer is absolutely yes. There is responsible capitalism. I wrote a book called Progressive Capitalism. I really believe that we can have a profitable capitalism that serves all of our society. You have to change some of the rules of the game, and you can't exploit the environment in the way that they did. You can't exploit the workers in the way that you did. But you can actually, I think, will have a stronger, more robust capitalism. The other question is the politics. Can we change the politics in a way that there will be a change in the way the market economy works? And I'm, quite frankly, I'm actually hopeful on that. Many of the countries in Europe have created a kind of social democracy where they've tried to temper capitalism, and in many of the social indicators, they do much better than the United States. Less inequality, and some of them are actually quite dynamic economies. So we actually have some proof that one can have a more socially just and environmentally friendly capitalism.
We have quite a lot of questions about Europe, and you have historically you were very prescient in seeing deep problems associated with the single European currency in the Eurozone. But when you think about those more social market policies in Europe, and some of the things we were saying earlier about governments perhaps doing a better job of holding on to jobs in response to this crisis, are you a little bit more optimistic about Europe's future now that maybe it has some strengths relative to the rest of the world?
Oh, it clearly has some strengths. If you look at those charts of how they've succeeded in controlling the pandemic, it went way up very early, and then they brought it down very significantly. And you compare that chart to the United States, it's very, very striking. And of course, that course of the pandemic will be the most important determinant, I think, of the course of the economy. I still am worried, obviously, about the European Union acting in a politically cohesive way with enough European solidarity. They've done some very good things. Their commitment to having the Euro bonds, 750 billion euros to help the recovery. But there are debates going on about who should get the money. Should they be loans versus grants? A lot of squabbling going on. And clearly, the answer to some of those questions is obvious. They need grants, not loans. Many of the countries that are most afflicted have very high debt levels already. So I would have liked to have seen more solidarity. That would give me a lot more confidence. But what is clear is the strong responses within the country that have enabled them to really tame the pandemic and to make sure that the economic burden is much more equitably shared than in the United States.
Well, to that point, I mean, there has been a lot of conversation about universal basic income. Do you think that's a conversation that will advance now in the US as well as in certain parts of Europe? We've seen some experiments, not entirely successful, with UBI.
Well, I'm not a big fan of UBI because I think that there's dignity in work. And I think we have a lot of work to be done. I think the green transition is a big deal. We need infrastructure. We have to improve our healthcare system. We have to improve our education system. We have a lot of aged people to take care of. So when I see the list of things that need to be done, and I see that there are a lot of people who actually want to work, I think our first obligation is to make our economic system work, to make sure that everybody who wants a job and able to work can get a job. And we are failing in that basic mission. And that should be our first priority.
And I guess one question is whether you see surprising countries coming out of this with a good mix of policies. We've seen emerging market economies, whether it's a part that you tell the story of quite a lot of emerging market economies, but other places like Indonesia and China have marshaled resources to respond to this threat and have been quite successful, it seems. Do you see us coming out of this with maybe a sort of a reordering of of countries with perhaps new respect for some, and I'm obviously speaking from London here, even less respect for others?
Oh, clearly. I think there are going to be a couple of principles that are going to emerge. I think we're going to realize how important government is. When you had a crisis, we all turned to government. 40 years of denigrating government in the United States and the UK led to a government that was less prepared. There's been a denigration of expertise in science. And this is a kind of situation where expertise in science really makes a difference. We've come to a new appreciation of the importance of social solidarity, respect for others, wearing masks. societies with more social cohesion have done a lot better than those where there's less social cohesion. So, you look around, the new league table, as you might put it. New Zealand is way up there, small country, but really they've got it under control. Iceland's gotten under control. South Korea has done a fantastic job. And I mentioned these countries. Some of them are really small democracies, but South Korea is a quite, fairly large country. Germany's done a better job. I think that we begin to understand that there are characteristics of the society when there's a kind of society working together and a trust in government, then things work a lot better.
Now, there'll be some people listening who say, I agree with all that, but it doesn't seem to be reflected in global markets at all. I mean, we have on the Bloomberg Economics, we have dashboards that we're now looking at the high frequency data of economies coming out of this crisis. And you're quite right. Germany and France have seen their economies, a big chunk of them, come straight back as restrictions have been lifted, not just because of the lifting of restrictions, but because people have confidence in the strategy. They don't think that they're going to get COVID-19. They think the government is kind of on the right track. If you look at the US, obviously we're seeing the risk of another wave, or indeed the continuation of this wave not having reached its peak, the number of cases going up. And yet in the financial markets are continually betting on the US over everybody else. Is that just going to turn out to be wrong? Or is it telling us that the financial markets are on a completely different kind of calculation?
Well, I think there are a couple of things going on with financial markets. There's always been a little disconnect between the real sector and the financial markets. Financial markets do well when wages are low, when interest rates are low. Wages are low is not a good sign of an economy. Interest rates low is not a sign of a good economy. It's a sign of a lot of worry in the economy. But I think there's something else going on. The enormous amounts of liquidity that's been put into the US economy and some of the European economies mean that people are, and in the context of a world of hoarding, cash balances have gone up and people want someplace to put that money yielding more than a zero return. And that, of course, a lot of people are hoping, praying that the financial markets will give them that higher return than zero. So I think there's a lot of speculative activity that has been generated by the massive amounts of liquidity that the central banks and governments have provided. And that's giving a particularly distorted view of the financial markets assessment of what is really going on in the real economy.
And we have actually Yanni Legbelos, who had asked about universal basic income, is also interested in Greece, because you talked about countries, Europe potentially doing better and having done some of the right things, but there are still countries that were weak and were not necessarily going to get enough support. Would you still maintain, or would you maintain that Greece will still be in the Eurozone over the next 10 years?
I think the future of the Eurozone will really depend on what policies Europe crafts. One of the characteristics of Europe has always been that it's done just enough to keep it together, but not enough to really do what is needed. So it looks like they are going to get some assistance to Italy. There's a lot of Euroscepticism in Italy. If they had done nothing, I think the chances of Italy leaving would have been very high. There was already a strong Euroscepticism, and some of the leading politicians were pulling Italy in that direction. And a lot of the population were supporting the view of Euroscepticism. If, as I think is likely, they will come to the help of Italy and Spain and the other countries facing the pandemic much more with greater force, I think that will renew the commitment to the European Union. But the fights at the time that are going on have shown that there's not strong European solidarity, and there's not a common vision of Europe. And in another dimension, the fact that Hungary has been moving even further away from a democratic framework means that Europe is not even sharing a common vision about what kind of political system. And the rest of Europe seems hesitant to enforce the kinds of provisions that are in the European Charter to discipline countries that depart from democracy.
Yeah, and you raise a good point there, and it's partly the rules of the system that make it hard. I think you have to have a unanimous vote when you do these kind of things, which you're not going to get from the country concerned.
You can have one dissent. The problem is that there are two countries that are at least are departing from democratic ideals, and they never contemplated the idea that there would be two bad countries at the same time. And now they're in what we would say in the Midwest of the United States, they're in a pickle.
But you mentioned populism, and I guess it comes down to this much bigger question about whether, when we look back, will we say that this was a real turning point for the global economy, where long existing trends kind of came to the fore and forced change, or whether it will some of those negative trends will actually accelerate? You know, after the global financial crisis, we also the legacy of that was to shake up global politics and have populism, but populism that often pointed in not in a constructive, in a worsening direction. You think there's more chance of a sort of positive form of populism coming out of this, that we will shake everything up and actually end up heading in a better direction, or is it still to play for?
I think it's still in play, and I won't call it populism, but I do think the November election in the United States is going to be a critical moment. The uprising, you might call it that, in the United States for racial justice really showed a dimension of the United States solidarity that had not been evidenced before. I take that as a sign that ideals really do matter, and that the conception of what a country together means really does matter. So I'm very hopeful that in November, there will be an outpouring, and that will lead the United States to go in a different direction. And that will have, I think, a very big effect on the direction in which the world goes. One of the issues you were talking about before is the new Cold War between China and the United States. And it's clear that those tensions are very strong. But it's also clear that we share the same planet, and we are going to have to work together to deal with the problems of pandemics, the problems of climate change. And so the question is, in the midst of a reordering of the world, are we going to be able to get cooperation across governments that fundamentally may disagree very deeply with each other? You know, you could imagine yourself in a rowboat, in a lifeboat. The ship is sunk, and there may be some people in that lifeboat that you really don't like, but that's not the reason why you should sink the lifeboat. And maybe that's a metaphor to say, you know, we're in this together. There are some others that we may not agree with, but we have some common problems facing the pandemic, climate change, global peace, that we have to work together on.
Well, it would be so tempting to leave it there, but I'm going to have a final question just to bring in the global perspective, because you mentioned the US-China, and actually, even if there is a change in the in the White House at the end of this year, there really is a different attitude to China coming out of the US now, and it's difficult for many to think that won't affect the nature of globalization and potentially cause a worsening divide between US and China. So you have made the point that we're all in one planet, but we are potentially developing lots of different technologies. We're potentially trying to encourage companies to come back to the US to throw away some of those very complicated supply chains. Is those forces of deglobalization, can they be stopped? How real do you think they are?
Oh, they're very, very real. In fact, we had, in the years after 2008 crisis, been in the process of moving away from what some people call hyperglobalization. You can see that, you could have seen that in the data, for instance, in the trade GDP ratios. That was going down before the pandemic. And the pandemic has exposed the lack of resilience in our global supply chains, the lack of resilience in our own economies. So I think definitely we're going to be insourcing. It's not going to solve our unemployment problems. Much of that insourcing is going to be robots producing the goods, the manufactured goods. The jobs are not going to be going back to the deindustrialized parts of the United States. Some of it will, but much of it will not. So it's not going to solve the problems that some of the protectionist issues, protectionism has focused on, but it will make our economy a little bit more resilient. The real question is, can we get the right balance? The concern is that if we don't get the right balance, it will be what Nouriel Roubini described as a very big negative supply shock. And that negative supply shock, we know what that can do. That can lead to stagflation, prices going up in the presence of a lack of adequate demand. So what he described as one of the threats to the global economy, I think is a real threat. It's not inevitable. It really depends on how we manage this process of, maybe delinkage is not the right word, because that suggests that we're going to be totally apart, but it's trying what I would call a rebalancing of the global order. And if we do it in an extreme way, I think we can all suffer. If we do it in a thoughtful way, and let me tell you, what is going on in the United States is not what I would say a thoughtful way. But if we did it in a thoughtful way, I think we will actually get a more resilient economy, not only for the United States, but I think a more resilient global economy as well.
Well, Professor Stiglitz, it's a pleasure. As you say, ideas matter, and it is great to hear someone who I know has a very clear sense of what is wrong in the world give us such an upbeat sense of what could change and the potential that's there. So I appreciate that particularly. You're looking at a lot of the same facts as Nouriel Roubini, but actually thinking that we can change course. So thank you again. You were very quiet in your plug for your most recent book, but I will say it's called People, Power and Profits, Progressive Capitalism for an Era of Discontent. So you should read that book. And if you want to listen to this conversation, lots of other conversations like this, also sign up for my podcast, Stephanomics. But thank you, Professor Stiglitz.
Thank you, Stephanie.
And thank you to all of you for joining the second day of Invest Global. We hope you enjoyed these discussions, and thanks again to our speakers. And I'd like to thank again CMC Markets, our Europe sponsor, for making this whole thing possible. Now, you should stay tuned for our day 2 sessions in New York at 1 p.m. local time. This is a rolling global event, remember, and you can see all the sessions from across the world archived right here on the Bloomberg Invest Global Event Hub, along with the recap videos and the Bloomberg intelligence data that you saw earlier, and everything from our sponsors. So, and tomorrow at 1 p.m. In Europe, my colleagues Eric Schatzker and Jason Kelly will be here to host the third day of Invest Global. You can follow us on @Bloomberg Live on Twitter and LinkedIn for updates of this whole event. And you should follow all the economics coverage we have with @Economics on Twitter, and the business and markets coverage on @Business, so @Economics and @Business, and on Bloomberg.com. And of course, if you haven't already, you should please consider subscribing to Bloomberg.com. Thank you very much.